Yes, very happy afternoon to all. This video is for CA final students. My dear lovable students, in CA final, non-resident is a very important part. The mark weightage for the non-resident is 30 marks. In that, 6 mark will come for double taxation avoidance agreement, either 6 or 7 or 8. I am talking about the minimum marks. We all know that RTP for November 24 examination has been released by ICAI. For that, I saw question number 20 is from double taxation avoidance agreement. I will explain you the question. If you are feeling any difficulty, you can use this video for your reference. Mr. Ram Prakash, a resident aged 58 years. We have to always, sir, note the age. 58, normal person. Has business interest in India and in some other foreign nations also. That means he is doing business in India and also in other countries. Okay, fine. He has derived income from 2 other nations. That means this is a multiple income DTAA question, which is from country X and country Y, with which India does not have double taxation avoidance agreement. Fine. So India does not have double taxation avoidance agreement in the sense means section 90 and section 90A will not be applicable. Section 91 will be applicable. The particulars of income earned in the 2 nations X, Y and in India during the previous year 23-24 are as under. For our previous year, they have tabulated the information. Very good. Particulars of income. The beauty of the question is, instead of giving para-wise, they themselves given in a tabular column where this is the income earned in country X, income earned in country Y, and this is the income earned in our country, that is India. Gross rental receipts from commercial property from country X and country Y, this will be taxable in our country under the head income from house property. Fantastic. When we are taxing that income, one thing you should have in your mind, the income is entitled to a deduction under 24A, which is 30% of the NAV, net annual value. Share of income from partnership firm, we all know that as per section 10 subsection 2A, share of income from partnership firm is exempted. It is a loss, not an income. The partnership deed was not evidenced by an instrument in writing. That means there is no written partnership deed. If there is no written partnership deed, that income is not exempted under section 10(2)(a). If that income is not exempted, even the loss is also not exempted. That means we are entitled to claim or set off that loss in India. Business income, this is the PGBP income, 2,80,000, 3,40,000 and 1,80,000. Short-term capital gain from the sale of vacant site. That means it is not from the super asset. Usually I used to say in class super asset. Super asset means nothing. Listed shares, units of business trust and units of UTI, that is that 112A asset, 3 assets will be coming no. So I call those assets as super asset, 112A asset. So this is by selling vacant site. Vacant site is not a super asset. So this is short-term capital gain. So provisions of 111A will not be applicable. Normal provisions will be applicable. 10,80,000. Long-term capital gain on sale of residential house in Delhi. So the residential house is situated in India. They sold on 1st March 2024 for 37 lakh. This is not full value of consideration. This is long-term capital gain. And the hero agriculture income. They are having agriculture income from outside India. We know the definition of agriculture income. In order to enjoy exemption under section 10 subsection 1, agriculture land should be situated in India. But these 2 agriculture land are situated outside India, hence it is not exempted under section 10(1), it will be taxable in India. The following investment were made in India during the year ended 31/3/2024. Purchase of residential house at Delhi on 18/3/2024 in joint name with spouse. There is no restriction. You can enjoy exemption under 54, capital gain exemption. Even though half of the house has been registered in the name of the spouse, the assessee is entitled for 100% of exemption or deduction under section 54. Transfer of residential house property and investment in one residential house property in India. But if that long-term capital gain is up to 2 crore, the assessee is entitled for 2 residential houses. Contribution to PPF, you are entitled to claim 80C, but you should be very careful under what route you are traveling. This is the income tax rate structure. In country X up to 3 lakh, it is nil. They are also following same like India. 3 lakh to 6 lakh, 15%. Oh my God, not 5, 7.5, 10 and all, straight away 15. Above 6 lakh, 22%. Wow. With regard to country Y, flat 27% without any basic exemption limit. There is no basic exemption limit in country Y. Tax treatment or concession in the other nations. No statutory allowance or deduction in respect of house property. Income in country X as well as country Y. But we are having that statutory allowance under section 24A. 30% of net annual value can be claimed as deduction. Loss from firm can be set off against other business income in country Y only and not in country X. Since there is no partnership deed, such income is not exempted under section 10(2)(a). But here it is not income, it is loss. If income, it is not exempted, taxable. That means if it's loss, that is also not exempted. That means it is entitled for set off. Agriculture income is exempt in country Y only and not in country X only and not in country Y. That means agriculture income is taxable in country X. Sir, it is exempted in country X only, exempted in country X and not in country Y means taxable in country Y. Compute the net tax liability of Mr. Ram Prakash for the assessment year 24-25, assuming that he is paying tax under 115 BAC. 115 BAC means default tax regime. Default tax regime means, my dear lovable students, they are not entitled to claim deduction under chapter 6A. So this 80C should be put it on dustbin. According to me, a beautiful, fantastic question for 6 to 7 mark in examination at CA final level. Because in order to solve this question in examination situation, you should really have the practice of doing question earlier. How this question has to be proceeded, we will understand, my dear lovable students. I will explain to you. You also enjoy how the things are moving. First one, computation of total income of Mr. Ram Prakash for assessment year 24-25. Headwise they are calculating. There is no income from salary. Fine, fantastic. First they are calculating income from house property. With regard to house property, sir, they are having rental income both from country X and country Y, but not from country India, our country. So total rental income received is 2,50,000 from one country and 2,50,000 from another country, put together 5 lakh rupees. Less LT bar MT paid by the owner, nothing has been given in the question. So the net annual value is also 5 lakh. Since it is in India, they are entitled for 30% standard deduction under section 24A. So 5 lakhs into 30% under section 24A comes to 1,50,000. So from 5 lakh, if you reduce 1,50,000, 3,50,000 rupees is the taxable income from house property in India. That's it, the first income we have finalized. Nothing. Sir, gross rental receipts from commercial plots, both 2,50,000 and 2,50,000 will be taxable in India after standard deduction of 30%. So total gross comes to 5 lakh. 5 lakh into 70% comes to 3,50,000 is the taxable income in India. We are going to find out the PGBP income. This is a business income given. We have to add all the income. So 2,80,000 is the business income from country X. 3,40,000 is the business income from country Y. And 1,80,000 is the business income from India, our country, which is basically totally 8 lakh. Sir, first we are supposed to do intra-head adjustment. Within the head we have to adjust. Within the head means this 1,20,000 and 1,30,000 is a loss from outside India. But there is no partnership deed. If there is no partnership deed, if there is no instrument, such income is not exempted under 10(2)(a). If that income is not exempted under 10(2)(a), my dear lovable students, that loss is entitled for set off. If the income is exempted, loss is also exempted. If the income is not exempted, then loss is entitled for set off. So against this 8 lakh, we can claim 1,20,000 rupees and 1,30,000 rupees. Fantastic to the core. So 8 lakh minus 1,20,000 minus 1,30,000 comes to 5,50,000 is the taxable business income in India. That's how we got 5,50,000. So we finalized income from house property as 3,50,000. Fantastic. PGBP as 5,50,000. This is the logic. You should understand the provision. Share of profit from foreign firm is not exempt. Why it is not exempt? Since the partnership is not evidenced by an instrument. So if there is partnership deed, the income from partnership firm would have exempted under section 10(2)(a). Since there is no partnership deed, that income is not exempted. Since the income is not exempted, even the loss is also not exempted. Hence the loss can be set off against the business income. That's why against the business income in India, we are able to set off that loss. Fantastic to the course, sir. Coming to the third head of income, which is short-term capital gain, we are having 10,80,000. This is gain, but not from super asset. 111A will not be applicable. Okay, fine. Noted that point. Long-term capital gain on sale of residential house. You look at this 1/3/2024 is the date of transfer of the capital asset. As per section 54, once you transfer a residential house property, you can either purchase or construct the new residential house property. If you are purchasing either 1 year before or 2 years after, my dear lovable students, and if you are constructing within 3 years, that's the relevance of the date. Sir, on 1/3 they have sold the capital asset, and on 18/3/2024 they have purchased the another capital asset. That means it is within 1 year. Within 1 year. Actually, if it is for purchase before 1 year and if it is purchased after 2 years, still 2 year time limit is there. If it is within 2 year time limit, so my dear lovable students, they are entitled for 54 exemption. So the long term capital gain is 37 lakhs. So long term capital gain on transfer of residential house in Delhi is 37 lakh. Less exemption under 54. Purchase of residential house in Delhi in joint name with wife within 2 years from the date of transfer, 25 lakh is eligible for exemption or deduction, whatever it may be. So the taxable long term capital gain is 12 lakh. We can't do anything with regard to short term capital gain. It is fully taxable. No deduction or allowance or nothing is available. So we have to just add back 10,80,000. So to 12 lakh, if you add 10,80,000, 22,80,000 rupees is the taxable capital gain, which comprises of both short term and long term. Fantastic, sir. Got the point. I hope you are understanding very well. Coming to IFRS, income from other source. You look at here, we have done with the rental income. We have taken care of the share of income from partnership firm. This loss we have adjusted against the business income. Then we have dealt with the capital gain, both the short term capital gain and long term capital gain, and coming to agriculture income. If the agriculture land is situated in India, then it is exempted under section 10(1). Whereas if the agriculture land is situated outside India, that will not be treated as agriculture income at all. So it will be taxable, my dear lovable students. So 3,40,000 plus 1,80,000 comes to 5,20,000 of agriculture income earned from outside India will be taxable. So agriculture income in country X and country Y, 3.4 lakhs plus 1,80,000, 5,20,000 is taxable in India. Whereas agriculture income from land situated in India is exempt under section 10 subsection 1. So that is nil. So 5,20,000 is taxable. Only the agriculture income which you have earned from outside India is taxable. So tell me, what is the gross total income? The gross total income is 37 lakh. What and all comprising? Sir, IFHP is 3,50,000. Income from house property is 3,50,000. Then PGBP, total PGBP income after claim of loss, you are having 5,50,000. Okay, sir. Then you are having capital gain, which comprises of both short-term capital gain and long-term capital gain. Long-term capital gain is after exemption under section 54. So that is 12 lakh plus short-term capital gain of 10 lakh 80,000 comes to 22 lakh 80,000 is the capital gain. Then coming to IFOS, since the agriculture land is situated in India, this 5 lakh 20,000 is exempted under section 10(1) and foreign 5 lakh 20,000 will be taxable. So my gross total income will be 3 lakh 50,000 plus 5 lakh 50,000 plus 22 lakh 80,000 plus 5 lakh 20,000 comes to 37 lakh is my gross total income. That's what they have noted here as 37 lakh. I hope you are comfortable up to this. Since the assessee decided to travel through Sir 115 BAC route default tax regime, we all know that there is no chapter 6A deduction under chapter 6A. So he cannot claim 80C to 80U, PPF will not be available. So the total income will be 37 lakhs in India. Now we have to very critically analyze the total income. Before we calculate the tax payable, always we will check that is there any special rate of income included in the total income. So in that 37 lakh, my dear lovable students, there is a special income which is nothing but agricultural income. But why, what motivated me to solve this question in YouTube? You know, because this line is a beautifully drafted by ICI. Mr. Ram Prakash, a resident. That means the assessee is a resident. Assessee is having income from India, income from first country, income from second country. And the beauty of that question is, assessee is having agriculture income from our India and also from the other country. We all know that as per 10 subsection 1, agriculture income is exempted in India. Whereas for the purpose of tax calculation, that agriculture income will be included in the total income. Because of including agriculture income in the total income will increase. Total income will increase. And you have to calculate the tax payable on that increased total income. My dear lovable students, since you are paying tax on an exempted income, you are entitled to claim rebate on agriculture income. The first rebate is section 91 rebate. Okay, that's okay. But you are supposed to include the exempt income in the agriculture income. This is called as SOPI, which we will learn, which we have learned or we are supposed to learn in our CA Inter. Scheme of partial integration. This process is called as SOPI, which is scheme of partial integration. That means for the purpose of computation of total income, we will exempt agriculture income under section 10(1). Whereas for the purpose of computation of tax payable, we will include that agriculture income also. Fantastic to the core. So my total income is how much lakh? 37 lakh. Add agriculture income exempt under section 10(1) is, sir, 5 lakh 20,000. 5 lakh 20,000. Sir, 37 lakh plus 5 lakh 20,000 comes to 42 lakh 20,000 is the taxable income for the purpose of paying tax. So this is called a scheme of partial integration. And another beauty of this question is, if you add, this is 5 lakh 20, and when you add this to, for this also you are getting 5 lakh 20, 3 lakh 40,000 and 1 lakh 80,000, 5 lakh 20, and this also 5 lakh 20. Sir, I added to the total income 5 lakh 20, this 5 lakh 20,000 only I have added, my dear lovable students. Because this is already there in the total income. This is already there in the total income. Super, sir. This only exempted under section 10(1). So this amount of 5 lakh 20 I have included for the purpose of computation of tax payable. This process is called as SOPI. SOPI in the sense means scheme of partial integration. Partial integration means some part I will pay tax. So agriculture income is exempted under 10(1), okay, fine, but you are liable to pay tax. What is this, sir? And you are entitled to claim rebate for agriculture income. So 42,20,000 is the taxable total income. Inside this check, is there any other income is there or not? Yes, sir. There is an income called as long-term capital gain, which are going to be taxable under 112. That long-term capital gain is 12 lakh. Fantastic, sir. At the rate of 20% will be the tax rate. So 12 lakh into 20% comes to, for this part, I am liable to pay 2,40,000. Comfortable, sir. I hope that you are able to appreciate or understand what I am doing. Whereas 42,20,000 minus, sir, 12 lakh rupees is the other income. So 42,20,000 minus 12 lakhs comes to 30,20,000 is the other income. My dear lovable students, for this you have to calculate the tax as per the slab rate, because 115, sir, BAC route will be applicable. That's what they have done here. Tax on total income of 12 lakh at 20% comes to 2,40,000. Comfortable, sir. Tax on other income of 30,20,000. This is what 30,20,000. For that, the tax rate slab applicable up to 3 lakh nil. We all know that as per 115 BAC, sir, up to 3 lakh rupees is nil. It's a game of 3 lakhs gap. 3 lakhs to 6 lakhs, we know that the gap is 3 lakh. So that is 3 lakh at the rate of 5%. At the rate of 5%. So 3 lakh into 5%, 15,000. Normal calculation only. Then next slab of 3 lakh, next round of 3 lakh, 6 lakhs to 9 lakh. The gap of 3 lakh at the rate of 10%, 30,000. Next slab of 3 lakh, 9 lakhs to 12 lakh, that is again 3 lakh at the rate of 15% comes to 45,000. Next slab of 3 lakh, 12 lakhs to 15 lakh, which is 3 lakh at the rate of 20%, 60,000. That's it. That is a maximum slab beyond 15 lakh, sir, till 30,20,000, because that's the income, no? So this 30,20,000 should be classified into two categories: up to 15 lakh and above 15 lakh. Above 15 lakh will be taxable at the rate of 30%. So 30,20,000 minus 15 lakh. The difference will be 15,20,000 into 30%, my dear lovable students. Into 30% means 4,56,000. 4,56,000. Here I know that up to 15 lakh, this is the tax payable comes to, which is 15,000 plus 30,000 plus 45,000 plus 60,000 comes to 1,50,000. So up to 15 lakh, we can say that 1,50,000. Basically, average rate of tax works out to 10%. This I am talking from the costing or FM angle, not from the tax angle. Because up to 10 lakh rupees in old scheme, we used to say that 1,12,500. In the new scheme, up to 15 lakh, we can say that 1,50,000. So 1,50,000 plus 4,56,000 comes to 6,06,000 is the total tax payable. I hope that you are with me. Fantastic, sir. Brilliant. So this is the tax payable for the normal, which is 6,06,000 plus already long-term capital gain 20% tax payable, which comes to 2,40,000. 6,06,000 plus 2,40,000 comes to 8,46,000 is the total tax payable, excluding surcharge and health and education cess. Now this tax, total tax payable of 8,86,000 include the exempt income under section 10 subsection 1 to the tune of 5,20,000 rupees. Agriculture income is exempted, but for the purpose of computation of tax payable, we have included that. Because of that, the tax payable would have increased. So what government is saying that for that you are entitled to claim rebate. For that you are entitled to claim rebate. Not under 91, my dear, under the agriculture SOPI scheme of partial integration. For that, what you are supposed to do, you know, first you have to take what is the agriculture income included in the total income, 5,20,000 at applicable basic exemption limit. What is the applicable basic exemption limit for this guy? 3 lakh. So 5,20,000 plus 3 lakhs comes to 8,20,000 rupees is the amount eligible for rebate. Sir, I don't understand the logic why you have added the basic exemption limit. Nothing. After calculating this amount of 3,20,000, I am going to calculate the tax payable. Look at here. In that 8,20,000, I am writing like this because of space constraint. Up to 3 lakhs is nil. We know, just now we put the calculation. Then 3 lakh to 5 lakh at 5%, 3 lakh to 6 lakh at 5%. The gap of how much lakh? 3 lakh. So 3 lakh into 5% comes to 15,000. Fine. Then 6 lakhs to 9 lakh, but there is no 9 lakh, so 8.2 lakhs. So 8,20,000 minus 6 lakhs comes to 2,20,000 into 10%. The next slab. So into 10%, 22,000. So 22,000 plus 15,000 comes to 37,000 is the tax payable for this 8,20,000. This amount you can claim it as, sir, this amount you can claim it as, this amount you can claim it as, my dear lovable students, rebate on agriculture income. Sir, if I don't add this 8 lakh, this 3 lakh rupees to the 5,20,000, then I will apply basic exemption limit on this 5,20,000. If only 5,20,000 is there, what I will do? I will say that up to 3 lakh on this 5,20,000 is nil. That means the tax liability will reduce. If the tax payable reduces, then automatically my rebate on agriculture income will reduce. So what government is saying that we don't want you to lose the rebate. That's why they are saying that just add back notional basic exemption limit, because up to 3 lakh, this whatever you have add back will be cancelled. Beautiful points, sir. Fantastic to the core. Hope you understood the logic. So that's why I have added back the basic exemption limit and I have claimed the basic exemption limit, because that agriculture income I made it as full taxable. Super, sir. So out of 8,46,000, my dear lovable students, I reduced 37,000. So 8,09,000 is the net tax payable in India. On that, since the total income does not exceed 50 lakh, because here it is only 37 lakh, less than 50 lakh, no surcharge implications will come. So add health and education cess at the rate of 4%. So 8,09,000 into 104% comes to 8,41,360 is the tax payable in India. I am going to calculate the average rate of tax in India, which is 8,41,360 divided by, don't take the total income including agriculture income, because that is required only for the purpose of computation of tax. This is the another area where we should be very cautious. We have to take only 37 lakhs. That means, sir, 8,41,360 divided by 37 lakhs into 100 means 22.74% is the average rate of tax in India. Now we have to calculate the rebate on first country and also rebate on second country. Fantastic to the core. Less rebate under section 91 with regard to country X and country Y. Come on, we will calculate that. This is a beautiful question. Computation of average rate of tax in country X. There you should have only one thing. You have to calculate the doubly taxed income. Only the doubly taxed income. So you have to calculate the doubly taxed income. How much income has been 2 times taxed in both the country have to be taken care. Fantastic to the core. So with regard to the doubly taxed income, gross rental receipts from commercial property 2,50,000. Right? No deduction is allowed from this in country X. In country X, this amount has not been allowed as no deduction. So 2,50,000 rupees has been taxed in that country. I am not calculating the doubly taxed income. First, I am calculating the average rate of tax in country X. Then we will calculate the doubly taxed income. When we are calculating the doubly taxed income, my dear lovable students, only the income taxed in both the countries should be taken. Here I am calculating, sir, now I am a chartered accountant of country X. I am calculating the tax liability of country X. In that mindset, I have to calculate. So gross rental receipts from commercial property, no deduction is allowed from this in country X. So the entire 2,50,000 is taxable. Share income from partnership loss is to be ignored because they have specifically told in the question regarding the loss that loss from firm can be set off against other business income in country Y only and not in country X. So country X they won't allow. So I am now thinking from country X. I am a chartered accountant of country X. So this much is taxable there. This cannot be set off. Sir, business income from that country, I earned a business income of 2,80,000. This is the business income. Fantastic to the course, sir. Business income. Short-term capital gain from sale of vacant site from the other country, 10,80,000. This is the short-term capital gain, my dear lovable students. There is no specific exemption or deduction. Agriculture income, we should be very careful since it is not, land is situated not in India, it is taxable in India, whereas it is exempted in that country. You read this line, agriculture income is exempt in country X only. So if you are a chartered accountant of that country, while calculating the income of that particular person, you will not include that income in the total income. I hope that you are getting, you are enjoying. So the total income of that country is 2,50,000 plus 2,80,000 plus 10,80,000 comes to 16,10,000, my dear lovable students. And they have given the tax rate of that country. How we will calculate the tax rate of India? The same way they given the tax rate. Rate of tax in country X up to 3 lakh rupees nil. 3 lakh to 6 lakh 15%. The gap is 3 lakh. 3 lakh into 15%, 45,000. Fantastic, sir. Above 6 lakh, so 16,10,000 minus 6 lakh, my dear lovable students, which comes to 10,10,000. So 10,10,000 into 22% comes to 2,22,200. So I am liable to pay a total tax of 2,67,200. So I am going to calculate the average rate of tax in country X, which is nothing but 2,67,200 divided by 16,10,000 into 100 is the average rate of tax. Divided by 16,10,000 into 100 comes to 2,67,200. Please use the calculator. Divided by 16,10,000 into 100 means 16.596%. Generally in question, they will say that average rate of tax in the other country is this much, but here we are supposed to calculate. This is another beauty of the question. And what should be the mindset when you calculate this rate? You should be a chartered accountant of that country. Don't worry how much is the doubly taxed income. That is a separate calculation again. So this is a 10 mark worth question. We should be able to get 10 mark. Now in country X, I am going to calculate how much is the doubly taxed income. That means 2,50,000 rupees is the income from house property. Out of 2,50,000, 30% we don't pay tax in India. Only 70% we pay tax in India. Up 2,50,000 into 70% comes to 1,75,000 is the doubly taxed income. So out of 2,50,000, 1,75,000 has been taxed in both the country. So only for that amount you are entitled for rebate. Fantastic to the course, sir. Share of loss from partnership firm. Sir, since the partnership firm does not have a partnership deed, that income is not exempted under section 10(2)(a). Since the income is not exempted, that loss is also not exempted. So we have set off that. So even though 1,75,000 is taxable in India, business income of India has pulls down by 1,20,000. So this 1,20,000 is not double taxable income, because there I don't got a benefit, but in India you got a benefit. So it reduces the business income of India. Already you got a benefit. Again, are you asking a rebate under section 91? Not possible. Hope you got the logic. Fantastic to the core. Business income, it is taxable in both India and outside India. So it is doubly taxed income. Short-term capital gain, taxable in outside India and also in India. Whereas agriculture income, look at here, agriculture income is exempted there. Exempted there means you have not paid tax there, but you have included in India, but it is not doubly taxed. Oh, fantastic to the core. Hence, I have to remove it. Here the pure logic, the same income has been taxed in that country, in our country is the question. So the doubly taxed income in country X comes to 14,15,000, my dear lovable students. Fantastic to the core. On this 14,15,000, I am going to apply the average rate of tax, which is 16.596%. So 14,15,000 into 16.596% comes to, sir, 2,34,833 is the rebate under section 91 for the first country. What a beautiful question is this, sir. Really enjoying, I hope. Look at the clarity. This is what you need at CA final level. Not only in direct tax, any subject. Enjoy your studies. Try to understand what you are doing. Then your life will be in a safer zone. Coming to country Y. Now, will you all think like a chartered accountant of country Y? What you are supposed to do in country Y, my dear lovable students? You have to find out the total income. Whatever income taxable in that country, taxable. Deduction minus deduction. Exempted, exempted. Fine. Gross receipts, sir, from commercial property, 2,50,000. Look at the wordings here. No statutory allowance or deduction in respect of house property in country X as well as country Y. So both in country X and country Y, statutory allowance of 30% cannot be claimed. What you are going to do? You are going to find out the average rate of tax, means you have to include everything. Average rate of tax in country Y. We are having this country, no, country India, country X and country Y. They themselves given the average rate of tax. So that table we are not supposed to perform it. Fine. How they would have calculated this? They would have taken all the taxable income. They would have not included the exempted income. That means we have to think like a chartered accountant working there. Then we have to calculate the total income and the flat rate of 27%. Since they have specified that 27%, we can skip that table. Fantastic, sir. Now only we are supposed to calculate the doubly taxed income. So out of 2,50,000, that 2,50,000 is fully taxable in that country, but out of 2,50,000, only 1,75,000 is taxable in India. So the doubly taxed income is 1,75,000. Business income, sir, there also business income 3,40,000 taxable, India also 3,40,000 taxable. So doubly taxed income is 3,40,000. Share of loss from partnership firm. With regard to the share of loss, they were having a loss of 1,30,000, but with regard to the loss from firm can be set off against other business income in country Y only. So there also you set off that loss. That means that share of loss from partnership firm, there also you pulls down. So it is not doubly taxed. It is not doubly taxed. There this 1,30,000 has been claimed as deduction. Sir, loss from firm can be set off against other business income in country Y only. So country Y you can set off, you set it off. So up to this amount there you have not paid the tax. Here also you not paid the tax. So it is not doubly taxed. Sir, then we have to ignore, no. If ignore, the income will be more. We have to remove that effect. So we have to minus 1,30,000. And agricultural income, in India you pay tax to the extent of, sir, agriculture income is exempt in country X only and not in country Y. That means in country Y you pay tax and also in India you pay tax. So it's a doubly taxed income. So 1,80,000 I am including. Fantastic to the core, sir. Hope you are getting. So doubly taxed income is 5,65,000. They themselves given the tax rate flat 27%. So 5,65,000, sir, is the doubly taxed income. Average rate of tax in country is 27%. whereas average rate of tax in India is only 16.596%. We have to apply average rate of tax in India or average rate of tax in foreign country, whichever is lower. Correct. So, double taxation relief at the Indian rate of tax. What is the Indian rate of tax? Indian rate of tax comes to 22.74%, or the flat rate average rate of tax in foreign country 27%, whichever is lower. So on 5,65,000 we have to apply 22.74%. So 5,65,000 into 22.74% comes to, sir, 1,28,481. So the total rebate under section 91 is 2,34,833 plus 1,28,481 comes to 3,63,314, my dear lovable students, from the total tax payable of 8,41,360. If you reduce this total rebate, you will get the net tax liability of 4,78,046. Since the last number is more than 5, which come to 6, the net tax liability will be round off to 4,78,050, my dear lovable students. What a beautiful question this is. This question is worth for 8 to 10 mark at CA final level. And my humble request to you is, don't skip double taxation avoidance agreement, because that will give you an 8 mark. It is there in RTP, it is there in mock 1, and it will be there in mock number 2. I hope this video finds some useful to you. If yes, if it is useful, if it clear the conceptual clarity, share your happiness as comments, my dear lovable students. If you need, I will solve the more number of questions from RTP and MTP at the specific areas or particular areas. If you want revision, that also I can do, my dear lovable students. Enjoy your studies. Don't skip double taxation avoidance agreement. We'll meet at the appropriate time with the required video. Those who are asking, till that, thank you, bye bye from my end.